Hey everyone, it's Senior Hannington, and today we are diving into the world of accounting. We are going to talk about the general journal, a fundamental tool for keeping track of your business's finances. Whether you're a student, a small business owner, or just curious about how businesses work, this video is for you. So let's get started. We have been given transactions of Max Limited for the month of January. You have the different transactions there. And when you try to look at the requirements of the question, you'll see that we are required to enter the above transactions in the general journal. So that part has 10 marks. Then define the following terms: expenses, assets, liability, owner's equity, and then income. So part A of the question requires us to enter the above transactions in the general journal. These are the transactions. And we are going to see how do we enter these transactions in the general journal. What is a general journal? Now, a general journal, this is a book of original entry in accounting, where all the financial transactions of the business are recorded in chronological order. In fact, the general journal serves as the initial record-keeping tool for any business, regardless of its size and complexity. So that is a general journal, book of prime entry, where all financial transactions of the business are recorded in a chronological order. Now, on your screen, you see the journal. That's the format of a journal. It has a column for date. That column for the date shows the date the transaction occurred. We have the particulars or the account title. That column records the name of the accounts affected by the transaction. Then we have the ledger folio column, which is used for reference purposes. Then we have the debit column. That column records the amount that are to be entered on the debit side of the T account. Then the credit column records the amount entered on the credit side of the T account. Sometimes when you're preparing a journal, you may have to give a brief explanation of the transaction. Now, when you try to look at this journal, you'll see that when we are preparing a journal, we should not forget the double entry principle. That every transaction affects at least two accounts. That's why you see that I have a debit column as well as a credit column. So for each transaction, there must be an equal debit and credit. There must be an equal debit and credit. Okay, so let's see how we can record these transactions in our journal. On 1st January, Max started a business with cash 2 millions and money at the bank of Ugandan shillings 3 millions. Now, before you enter these transactions into the journal, you have to know the rules of double entry. When it comes to the rules of double entry, we need to know when do we debit and then when do we credit. When do we debit and then when we credit. Those rules, if you follow them, you can ensure accurate and reliable financial records. When you look at the first transaction, on 1st January, Max Limited started business with cash 2 millions and money at the bank 3 millions. The money you start the business with, that is referred to as capital in this case. When you try to look at that first transaction, you'll see we have cash, and then we have bank. But the cash and bank we have, that money is used to start up a business. Max Limited is starting up a business with cash, 2 millions, and then money at the bank, 3 millions. Cash and bank, those are assets to Max Limited. And according to the rules of double entry, assets increase with a debit entry. Assets increase with a debit entry. So we see Max Limited is starting a business with cash. Now the business has cash, and then the business still has some money at the bank account. So cash and bank, those are assets to the business. So they increase with a debit entry. What about the corresponding credit entry? Now capital increases with a credit entry. Capital increases with a credit entry. Capital increases with a credit entry. So for the very first transaction, what we are going to do on 1st January, we see the business is starting. Max Limited is starting a business with cash at hand, and then some cash at bank. So what you have to do is a debit entry has to be made in the cash account. Cash is how much? Cash is 2 millions. So I have to debit 2 millions. But remember, for each transaction in accounting, that transaction should be recorded, at least it should be affecting 2 different accounts. So every transaction affects at least 2 accounts. In this case, cash is going to be debited. Then I have to credit capital, because Max Limited is starting the business with cash. So capital increases, and I've told you that capital increases with a credit entry. Still, Max Limited is starting business with some money on the bank account. Bank is an asset, so the bank will increase with a debit entry. How much is bank? The money at the bank account is 3 millions. Still, that money is used to start up a business, so my capital is to be credited. That is 3 millions. So that's the very first transaction, and you see I've followed the rule of double entry, which is debit and credit. So cash of 2M, I've debited my cash account and then created capital, because that cash of 2M is used to start a business, and then the money at the bank account is also used to start the business. So I'll debit bank and then credit the capital account. As you can see, this is all on the same date. This is all on the same date. This is all on the same date. So that is my first transaction. That's my first transaction. We have recorded it in the journal. That is our first transaction. Can move to the next transaction, and then we see what we are supposed to do. On 3rd January, purchased goods for Ugandan shillings 600,000. Purchased goods for Ugandan shillings 600,000. So here we need a purchases account and then cash. We need purchases. We see the purchase of goods. So these goods that have been purchased, they will be recorded in the purchases account. So here I have 2 accounts that are affected by this transaction. That is the purchases and then cash. Now our cash is reducing when we purchase the goods. our cash is going to reduce. However, purchases that can be looked at as an item of expense. So when the expense account is increasing, it will be debited. Okay, so when the expenses increase, they are debited. So in this case, I'll debit the purchases, that is on 3rd. So on 3rd January, purchases are to be debited. The amount is shillings 600,000. But when I purchase these goods using cash, cash is to be credited, cash reduces, cash is reducing, cash is an asset, and the credit entry reduces the asset account. So that is the transaction on, that's the transaction on 3rd. That's the transaction on 3rd. Then next transaction, on 6th January, bought a motor vehicle for Ugandan shillings 1.5 million, 1,500,000 by check. Motor vehicle, this is an asset. So we see that in this transaction, we are increasing assets because we are buying a motor vehicle. So an asset increases and this has to be debited. So we have to debit the asset account, and in this case our asset account is a motor vehicle. So that is on 60th, motor vehicle, 60, motor vehicle, 60, motor vehicles purchased. So I have to do what? We have to 60 Jan motor vehicle is purchased. Motor vehicle. Now I've told you motor vehicle is an asset of the business. So we have to debit the motor vehicle account because now the motor vehicle account is increased by 1.5, but an asset is reducing, which is bank, because we are using our money on the bank account to buy this motor vehicle. So bank should be credited in this case. Bank should be credited in this case. That is the transaction on 60. That is your transaction on 60. So you see, each and every transaction at least affects 2 accounts. Each transaction will always affect at least two accounts. The next transaction is on 7th, sold goods for UGX, that is Ugandan shillings 300,000 cash. So we see a sale of goods, cash. So cash, as I have already told you, cash is an asset to the business, and now when we sell goods we receive cash. So cash increases, meaning that if I'm increasing cash, I'll make a debit entry in the cash account. So the cash account is to be debited. This is on 7th. So on 7th January, on 7th January, 7th January, cash has increased. Cash has increased by how much? By 300,000, because the sale is by cash. But then now we are selling. When we sell goods, we have made sales, so that money that has been received, the cash that has been received, should be recorded in the sales account. That money that has been received as a result of sales should be made in the sales account. Now the sales account, that is an income. Sales, that is an income to the business, And according to the rules of double entry, when the income increases, the income account is to be credited. So in this case, what I'll do, we are going to credit our sales account. We are going to credit the sales account because sales, that is an income, and we see the income, which is sales, is increasing because of the goods that were sold by cash, 300,000. Then on 15th January, purchased more goods on credit from TK Limited worth Ugandan shillings 500,000. Purchased more goods on credit from TK Limited worth 500,000 Ugandan shillings. So in this case, we are purchasing goods. This is on 15th. Business is purchasing goods. Of course, you know, when we purchase goods, our purchases increases. So purchases, that is an item of expense. So it's going to be debited. The purchases will be debited. That is on 15th. So on 15th January, purchases are increasing. Purchases increasing. How much? 500,000. However, this time round, the purchases are increasing, but we have not paid for the goods. Whenever, in fact, they have made it clear that the goods were purchased on credit. The goods were purchased on credit. So this is a credit purchase, and now this credit purchase gives rise to the recognition of TK Limited. TK Limited is a creditor to the business. TK Limited is a creditor to the business. A creditor in accounting, that is an individual or entity that lends money or extends credit to the business. So in this case, TK Limited is a creditor. Creditors, those are liabilities. In accounting, creditors are liabilities. So when the liability increases, it is credited. So in this case, our liabilities are increasing. So we have to credit the creditor's account, and that is TK Limited. I will not use cash or bank because this transaction was on credit. The business purchased goods on credit, so we have to credit the creditor's account. So TK Limited is a creditor. It's 500,000. So according to the rules, liabilities should be credited if they are increasing. But in this case, we are increasing the liability. That's why making credit entry in the account of the supplier, and our supplier is TK Limited. Supplier is TK Limited. Then from that date, we move to 20th Jan, obtain a bank loan of 3 million cash. Cash is increasing in this case. That is on 20th January. Cash increases. Cash increases by how much? Cash increases by 3 million. So you debit cash in the general journal. Debit cash in the general journal. Then we have a bank loan, because our cash is increasing simply because of the bank loan that is being obtained by the business. So bank loan, that's a liability to the business, and we have seen already that liabilities will increase with a credit entry. So we credit the bank loan. Credit the bank loan. We credit the bank loan in this case. So that's the bank loan, that's the transaction. Cash has increased, so that is an asset, increase the asset. Because our asset is increasing as a result of the business obtaining a loan from the bank, Then we have to credit the bank loan. So bank loan, that's a liability to the business. We are going to see what assets are. We are going to see what liabilities are. We are going to see what the expenses are, as well as incomes, because that is part B of the question. So I'll try to explain that. Then after 20th, we move to 23rd. Sold goods for Ugandan shillings, 200,000 on credit from Martha. So the business is selling goods on credit to Martha. When we try to look at that transaction, this is a credit transaction, and it's a sale. The business is selling goods on credit to Martha. Now Martha is a debtor to the business. Martha is a debtor to the business. In accounting, a debtor is an individual or entity that owes money to another individual or entity. So in this case, Martha owes money. In this case, Martha owes money to the business. So a debtor is an asset to the business. Martha has a financial obligation to repay the debt of 200,000. So Martha is a debtor to the business. Sometimes you can use the term trade receivable. Instead of using debtors, we can use trade receivable. So on 23rd, the transaction gives rise to an asset, and our asset in this case is the receivable, who is Martha. Martha is a debtor, a business, or a receivable, and debtors are assets to the business. According to the rules, if I'm to increase an asset account, I have to make a debit entry. So Martha's account should be debited. Then this is a sale. Of course, when we sell goods to Martha, our sales are going to increase. Sales, that is an income to the business. Incomes increase with a credit entry. Incomes increase with a credit entry. So that is the transaction on 23rd. That's our transaction on 23rd. What else do we have? On 25th January, Martha paid Ugandan shillings 80,000 cash. Martha is paying. So when Martha is paying, first of all, our cash is increasing, the asset is increasing. That is on 25th January. We are receiving cash from Martha. Martha is paying how much? Martha is paying 80,000. Martha is paid 80,000. So now Martha's account is going to be credited. We are going to reduce Martha's account because it's now paying part of the credit. It's now paying part of the credit. So out of the 200,000, now we see that Martha has paid some 80. Martha has paid some 80,000. So Martha has paid part of the credit. So assets increase with a debit, and then assets reduce with a credit. So in this case, you see cash has increased because we are receiving cash, but then Martha, who is a debtor to the business, Martha is paying, so Martha's account is reducing. Martha is an asset, a debtor to the business, so we have to make a credit entry in the customer's account when that customer pays. Then sold goods on credit to Peter for Ugandan shillings 100,000. This is similar to the transaction on 23rd. So we are selling goods to Peter for Ugandan shillings 100,000. This is on 26th. So on 26th January. 26th January, you debit Peter. Peter is a debtor now. the business, there is the data, how much are the goods. The goods sold were worth 100,000. The goods sold 100,000. Cost, since this is a sale, shall credit our sales account with 100,000. We shall credit the sales account with 100,000. With 100,000. So that is Peter, that is the transaction. Then what else do we have? Finally, 29th January, purchase goods from John on credit for 300,000. Goods purchased, those are purchases. That is on 29th. On 29th January, purchases are to be debited. Told you purchases, that's an item of expense. If you're increasing an expense, we debit. That is 300,000. But these goods have been purchased on. These goods have been purchased on credit. The goods have been purchased on credit. The goods have been purchased on credit. So what do we have to do? We have to credit. We have to credit the supplier's account, and in this case, the supplier is John. The supplier is John. Supplier is John. Goods have been bought from John. So John is a creditor. So credit transactions, either you have to create a creditor's account or a receivables account when it comes to creditors. When it comes to credit transactions, either you have to create a receivables account or a debtors account as well as creditor. That is only if it's a credit if it's only a credit transaction. If the transaction is cash, then it's either, if the transaction is cash, that will be cash account. If it is sold by check, then that will be bank account. So this is our journal. This is our journal in this case. This is our journal. I've ignored the narrations. And still, when it comes to the folio column, I've also ignored this because we don't have details about folio, the reference numbers. We don't have that. That's why I've ignored that column. But normally, if we have that information, then we can enter the details, the reference numbers for the different transactions. We can enter them, but in this case, I've ignored that column simply because I don't have that information here. But always that information is available, then you have enter that here. You don't have that information. So that's your journal. As you can see, the journal, you have to show the date, the account title or the particulars, the ledger folio, the debit and credit. debit and the credit. Don't forget the rules of double entry bookkeeping. The rules are very, very key when it comes to recording transactions in the journal. Those rules are very, very key when it comes to recording transactions in the journal. So after recording these transactions here in the journal, these transactions are now posted to their respective accounts. The transaction will be posted to their respective accounts in the general ledger. So from the journal, now you can post to the different accounts in the general ledger. But of course, according to the question, we are just required to record the above transactions in the general journal, something which we are seeing. So the rules are very, very important when it comes to recording transactions in the general journal. Define the following terms: expense, asset, liability, owner's equity, incomes. When it comes to expenses, you're required to define an expense here. Now, expenses in accounting, these are decreases in assets, or you can define them as increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. That definition is according to the conceptual framework for financial reporting. An asset, that is a present economic resource controlled by the entity as a result of past events. A liability, that is a present obligation of the entity to transfer economic resources as a result of past events. Owner's equity, that is the residual interest in the assets of the business after deducting all its liabilities. Incomes, those are increases in the assets or decreases in liabilities that result in increase in equity other than those relating to contributions from holders of equity claims. Income will include revenues and gains. So thank you for watching. In this video, we have looked at the general journal, and then we have also looked at the definition of assets, expense, liability, the owner's equity, and income. Now, when you try to look at these are elements of financial statements, all these 5 terms are elements of financial statements according to the conceptual framework for financial reporting. Those elements, the assets, the expenses, the liability, owner's equity, and incomes, they are very fundamental when it comes to preparing financial statements. In fact, they form the building blocks of financial statements, and they provide a framework for understanding and analyzing an entity's financial performance. Thank you for watching. I remain your tutor, Senior Huntington. Don't forget to subscribe, don't forget to share, don't forget to like. Bye-bye.